Welcome back to the Money Seed Podcast. I'm happy to have back Jerry Fetta. Jerry was our guest in episode 67. He is the CEO and founder of Wealth DynamX. And today we are going to get into the nuts and bolts of an infinite banking policy. Jerry's going to take us through what it is, what are the concepts, and even we'll take a look at his own policy and how it all works. Jerry, welcome back to the show.
Gabe, thanks so much for having me back on. I know last time was kind of a hard and fast episode, so I'm glad to sit back down with you and we can have a little bit more of a longer conversation on this stuff.
Yeah, thanks very much. You know, I've heard this term infinite banking quite a bit, but I think today is going to be one of those opportunities where we are going to go deep into what it is and how it works. I'm excited to get into it. So, Jerry, at a high level, for those who don't know, what is infinite banking?
So infinite banking is actually more of a concept, right? And so it's the idea of becoming your own banker, being able to deposit money into something, borrow against that deposit, just like a bank would do with our deposits when we put them in a bank or a credit union, still have that deposit earning interest, but then as the banker, have the ability to then take that money and invest it, loan it out, use it to make wise financial decisions, and to earn that spread, that difference between what I'm earning on my investing or loaning out versus what I'm paying when I borrow, and really profiting from that whole system. So that's kind of the concept, and it's a concept that already happens with our money. We're just changing one thing, which is the location, and that puts us in the driver's seat as the bank. And then the tool that we use is a life insurance policy. So we'll dive into that today too. If it was water bottles that did this, I would be on the podcast today telling you about how good it is to put your money in water bottles. So the policy is kind of the inconsequential part. It just happens to be the right tool for this concept.
And I'll tell you, when I first heard about it, it really did seem like this was one of those too good to be true kind of things until I found out that it is the life insurance policy that makes it possible. Because typically it almost sounds like the money is doing two things at once, right? It's there in a savings account, growing for me, collecting compound interest. And at the same time, I have access to it. I can withdraw it. I can invest it somewhere else. And it's like the money is in two places at once. And when I first heard it, I'm like, that doesn't sound right. That there's something funny going on here, but it's totally legit. It totally works. So why don't you tell us more about the basics and how a life insurance policy can do this? Why would a life insurance policy lend money to a policyholder? And let's dive right in.
Yeah. So what I want to do is I want to first kind of set the stage with the concept, right? And part of this is really having kind of a paradigm shift with the way that we think about money, because much of what we think about money is what we've been told to think about money, right? So I'm going to share my screen and just go over a quick concept with you here. So let's say Gabe, that I'm going to buy a car and you're my banker, right? And so I've got money in my account with you, and it's a magical account. I'm earning 4% interest on my 25,000 here. And you're my banker, and you're glad that I'm doing that. And I'm like, okay, I'm going to buy the car. And my first thought is, okay, everyone I've ever talked to says you pay cash for a car. Dave Ramsey says to, my grandma says to, my dad says to, so I want to pay cash for my car. So I go to you, Gabe, you're my banker. And I say, hey, Gabe, I'm going to buy a car. I really don't want to do a loan. I don't want to pay interest on a loan. And so I want to take my 25,000 out, and I'm going to go buy a car with that money. Now, Gabe, you're a wise banker. And so you stop me and you say, no, Jerry, I want to just show you something real quick. Okay. I want to just, you have your money here at 25,000 at 4%. Instead, why don't you leave your money in your account, and I'm going to loan you 25,000 at 6%. Okay. Now, my first instinct is like, Gabe, I'm no idiot, right? I don't want to pay 6%. I would rather just take the money out. Sure, I lose the 4%, but I can do basic math. 4 is less than 6. And you're telling me, no, Jerry, you will make more money if you leave the money in the account. Okay. Now, here's where the mindset starts, is we have to really look at like the way money works with banking. Interest is often a red herring. When you think of magic, a red herring is the thing that distracts the audience from the real trick while the real trick happens. And so bankers do not pay their shareholders in percentages, they pay them in dollars. And so when we look at the dollars of this transaction, what happens is $25,000 at 6% for 60 months is a monthly payment of $483.32, right? Now, if I were to do what Gabe said, leave my money in the savings account with Gabe, it's growing at 4%, borrow Gabe's money at 6% to then go buy the car, my total cost on this car loan over 5 years is only $28,999. Right? Now, if my money stayed growing at 4%, meanwhile, while all that's happening, my money grew to $30,525. And so I indeed did make more money by paying 6% interest on a loan for 60 months while leaving my money growing at 4%. Right? And this is that paradigm shift. Now, why is that? Well, it's compounding interest, right? Albert Einstein didn't actually say this, but he's credited with it as the eighth wonder of the world, right? But it kind of is. That is a true observation. 25,000 at 4%. Well, it's 4% of a growing balance every single year. Versus on a car loan, it's 6% of a shrinking balance every single year. And so this is one of those things that we have to look at. Okay, the idea of borrowing rather than withdrawing. Right. And this is where that banking concept comes into play. Now, if we were to change just one thing on this, right, and this one thing is the location that we put the money. So if I'm the individual here, Gabe was a great banker. That's awesome. But on this transaction, Gabe is making the interest. What if I could make the interest? What if I could be the banker? What if I could be the one calling the shots? So if I change just one thing, which is the location I put my money, and I change that to a life insurance policy, right? Now, this is, again, another paradigm shift. We have to think about life insurance differently. This is not what you're going to buy at State Farm. This is not what your brother-in-law that just joined that network marketing company is selling you. This is not the thing that you're going to see, with your financial advisor. Less than 1% of life insurance policies are designed the way that I'm about to show you. And very specifically, this kind of life insurance is called high early cash value, dividend paying whole life insurance. Very big name. And the reason it's a very big name is it's a very specific thing. The more specific something is, think about where your address is. How long is the name of your address versus just the city you live in? Right? So we can't just say Tampa, Florida, like I live at this exact address, because that's the level of specificity that I want. And same thing with this life insurance. So what is it? It's whole life insurance. And Gabe, you'd ask kind of why would we use it for this? This happens to be the best tool. So it's something that does have a death benefit. Right? It lasts your whole life. That death benefit will go to whoever you choose. That's a legacy play. Now, when I was a kid, Gabe, did you ever play like Monopoly and Risk and these different board games?
Absolutely.
So my family, my dad and my brothers, there was always at least one cheater amongst the bunch. And as you know, it's not the most ethical way to win, but it's the best way to win. It's if you can cheat and nobody else knows, you can win the game. And so with life insurance, with the game of wealth, you're securing the odds. You're kind of cheating. You're saying no matter what, if I don't hit my target, my family's still going to be wealthy. Right? My churches, my charities, the ones I care about, it's a whole life insurance policy. That death benefit will go to someone tax-free. And if I live till age 121, they're going to pay it out even while I'm still living. No matter what, this will happen. I'm securing my odds. Right? So that's the best way to play the wealth game, is secure the odds first, and then you do the hard work between now and then to make sure you do make it. But if you don't, you know that you've got the game secured anyways. The whole life insurance policy has a tax-free savings account. From a security standpoint, the concept and the companies we work with, they're companies that are 150 to 200 years old. They actually predate the IRS. They predate the central banking system. They predate the financial institutions we give our money to right now. In a nutshell, the dollars that I put in will grow at about a 3 to 5% tax-free rate. And that's for the rest of my life. It's guaranteed to grow and guaranteed to not lose. And the guarantee is only as good as the guarantor, right? So someone can guarantee something. It's different though when they say, hey, for the last 170 years, we've actually kept that promise. Through the Civil War, through the Great Depression, through World War II, through the 1950s recession, through the 80s, through the tech bubble, through the mortgage crisis, through the COVID, through the supply chain crisis, even during now where we've got these crazy uncertain times, these insurance companies have never lost money and they've always paid their dividend as promised. And there's not another asset that I know about that has that level of consistency, right? And then the other thing that I love about this is by setting this policy up correctly with the right company, you actually become an equity partner in the insurance company. And so they share their profits with you, right? Now, I used to be a Wall Street guy. That's not how it works in Wall Street. Wall Street, the only rule is you pay them their fee and their commission, whether they make your money or whether they lose you money. And so when you're dealing with these financial behemoths, the best way to protect yourself is to join them, to be in alignment with them. What they do to themselves, they do to you. What they do also happens to them. And they're not going to do things to you that they don't want to have happen to themselves.
And Jerry, when you mentioned that it grows at 3 to 5%, and you also mentioned that you share in their profits, is that the same thing, or are the profits on top of the 3 to 5?
So that's kind of a blended number, right? So generally you're going to have a guaranteed interest rate. And these are gross numbers, meaning there are costs of insurances and fees. And then there's also the specific design. How is the policy put together? So the insurance company on the deposit, they're typically going to guarantee maybe 2.5 to 3.5% guaranteed interest growth on your cash, right? Now, in addition to that, they have what's called a dividend surplus. And so every year, just like any large company, they're going to predict their profitability. They're going to look at what are their targets and benchmarks for the coming year. And when they exceed those, they take that surplus and they share that back to their policyholders, because their policyholders are treated as equity owners in the insurance company. They're not publicly traded companies. You cannot go buy stock in these corporations. And we're talking some of the largest and most established companies on the planet, right? So, that dividend surplus typically is going to be another maybe 1 to 3%, depending on the year and depending on the company. So your gross credit rating of what you're earning on that policy between your guaranteed rate and your surplus dividend on most years in current time is usually going to be about a 5 to 6% gross rate. I keep using this word gross because there's going to be, if I'm reinvesting and putting that back into my policy, of course, there's some cost of insurance and some drag there. And then the other thing is 5 to 6% of what, right? Depending on how you design your policy, how much is in cash value, that's going to dictate that. So when I say 3 to 5%, this is my simplified way. This is how I think as an investor. I put in X amount of dollars. It was there for this long, and here's how much I got. Right. And if I do that calculation, that's called a compounding annual growth rate. And that's net of fees and everything. As I put in $10 and it turned into $30 over 30 years, and there's an exact rate after all the fees came out. So this is after all of that on a compounding annual growth rate basis. That's the net return. And that's the one I like to report with people, just so they can think with it. If I say it's a 6% dividend, kind of sets the expectation. I might always be earning 6%, and that's not always going to be the case.
Got it. And you keep mentioning this word cash value. I think now we're getting into the actual policy itself, right? And what do you mean by things like cash value or death benefit, and how do these relate?
Yes. So I'm going to give you guys a quick schooling up on how insurance works when it's whole life insurance, right? So I'm going to share my whiteboard. So with whole life insurance, you have a couple of different components, right? So you have what's called your premium. And we all know what a premium is. We pay premiums on various kinds of insurances. Here we have our death benefit. And then we have also our cash value. Okay, so the way that this works is the insurance companies are very highly regulated. They have requirements on how much they need to set aside for reserves. So you have to understand what's fundamentally happening when I engage in a whole life insurance contract, right? That whole life insurance company is promising to pay a death benefit to me and my family, no matter what. Like, it's a permanent contract. And if I live till 121 years old, they pay it to me even if I'm living. So there's no scenario other than me canceling the policy where they're not on the hook, right? They have to pay me that death benefit. So the premium, let's say, is $1,000 a month. That's how much I'm paying for coverage, right? Now that premium might secure me, and this is just arbitrary numbers here, right? Let's say that premium secures me, in today's dollars right now, $500,000 of death benefit coverage, right? So the insurance company has a guaranteed liability. They're collecting income here. And then the government tells them, hey, you need to be setting aside reserves for this. You cannot have Jerry turn 97 years old and die, and then you guys don't have the money. It needs to be there. And if you're telling him when he's 121 years old, you're going to pay it all out, by golly, it better be there. You need to pay it out to him. So they start building what's called a cash value, which is essentially kind of building up the reserve for that policy. This is also known as a net surrender value in the insurance world. It's a different term for the same thing, but I want to use that term because it kind of gives you the idea, the net surrender value. So I'm putting money in, I'm securing a death benefit. The insurance company is setting aside a portion of these dollars and they're building up that reserve, right? That's kind of like, if you think of it, it kind of is akin to maybe equity building in a home, right? The more you make that mortgage payment, the more equity you're building over time. You have principal and appreciation and all these things. So they have a net surrender value. So let's say in year one, my net surrender value on putting in, $1,000 a month, that's 12,000 for the year. Let's say that my net surrender value is 10 grand. Okay. $10,000. And that's, what they've got set aside. The insurance company has an agreement that at any time I could go to them and they'll buy me out of my contract. Think about it. If they can get the liability off the books, they don't necessarily want to have to pay me $500,000 if we're not serious about the relationship, right? So at any time I can go to them and say, hey guys, I don't want my policy anymore. And they say, great, we will pay you $10,000 net surrender value. You don't pay premiums anymore. We don't have to cover you anymore. Said and done, right? So this now exists as an asset. I don't have to do that, but that number is there as an asset. And with it being an asset, I'm allowed to borrow against this asset, right? And that's where the collateral value of doing this cash value. So we call this cash value. As a policyholder, that's my money. That's the money that's in my savings account. Any day I could cancel my policy and get that money out. Or I could leave my policy in force. I keep making the premium payment. I still have that death benefit. And then this guy here, every year it's going to earn dividends and it's going to earn interest. And it's going to compound and it's going to grow. Right? Now think about this goes all the way back to the 1800s. Right? So this is a system, like I was just watching a documentary last night on my all-time hero, Teddy Roosevelt. Teddy Roosevelt, when he died, he had the equivalent of today's dollars, $1 million in cash value and a whole life insurance contract designed just like this. Right? We're talking like, things that go way back. We've all had McDonald's before. Ray Kroc funded McDonald's with his life insurance policy. He actually borrowed from his policy to fund the Ronald McDonald campaign. Right? We look at J.C. Penney. They're not doing so hot right now, but James Cash Penney used his life insurance policy to keep J.C. Penney's doors open during the Great Depression. Right? Walt Disney, he funded Disneyland with a loan from his life insurance policy because every single bank he went to said he was crazy. And he said, no, I know this concept will work. And so he was able to borrow against his life insurance policy. And that's why we have Disneyland.
Amazing.
Right? So there's so many applications of this, but that's that cash value. That's that death benefit. That's that premium. And so, in my world, when I hear premium, I think of a bad thing. I'm like, well, I've paid for health insurance all my life. I've never used it. I've paid for car insurance all my life. I've gotten in a wreck maybe once or twice. It was never my fault. Never used it. Right. And so I'm thinking, with insurances and premiums, I'm like, that's a bad connotation. So I have in my own world gotten rid of the word premium and I call this my deposit. Right. The words we use matter. When I call this a deposit, now I'm thinking more like I'm putting money in my bank. And I like putting money away. I like saving money because that means investing and good things happen when I do that. I don't mind a death benefit. I like that. I like the idea that my family's going to be okay. They're going to be financially secure. A friend of mine, he's got he's got more than a dozen of these now. His family will get $30 million when he passes away.
Wow.
$30 million. We're talking major wealth now, right? And then the net surrender value, the cash value, this is the money that I can then borrow against that earns those dividends and it earns that interest, right? And so that's kind of the play-by-play. And so at the end of like year 121, the death benefit will be equal to the cash value.
Got it.
Right.
Okay. Yeah.
Those numbers level up until they finally catch up at age 121 years old. And that's where the insurance company is like, dude, it's the same number. Like, you're still alive. Congratulations. We don't know how you did it. They'll stroke me a check anyways, even though I haven't died.
Makes sense. Okay. So far to me, this sounds like an insurance policy, and it sounds like, okay, I'm putting money in. If I pass away, my family gets my death benefit. There's this thing called the net surrender value, which if I live to 121, is going to be the same as death benefit. How does this become like a bank?
Yes, this is the fun part. Okay. So this starts to become like a bank. And to understand this, we have to understand banking, right? So I'm going to share a concept called the banking quadrant. I believe other than earning income, this is the next most important concept everyone on the planet should learn. And nobody teaches us this. I would have learned this in fourth grade and understand what it meant, right? Oh, that's the wrong. I don't want to share my whiteboard. Let me share my banking quadrant instead. Here we go. So this is the banking quadrant. Now, we're all probably pretty familiar with the cash flow quadrant, right? You've got employee, business owner, employee, self-employed, business owner, investor. This is called the banking quadrant, right? And so when we're looking at a bank, we've got 4 different parties, similar to like with our cash flow quadrant. But what happens is we first have the depositor, right? So a bank does not have money until it has a deposit. And so the depositor needs to put money in that checking account and that savings account. They're typically depositing their earned income. Now, right now, the average savings account on a high end is paying 0.40% per year, right? That's what we're going to get kind of across the board at a good bank. My bank, is less than that. But if you go to a really good bank, you might get that. Now, you then have the bank. Okay, the bank and the banker. What their job is they actually borrow against the deposits. Right. So they're borrowing 98 to 100% of what we put in. Okay. And so what that means, and I like to tell this story, Gabe, because with people with money, they don't always get it. When we move it to a different object, it's easier to get. Right. So Gabe, let's say that you're taking a trip, right? You're going to go on a vacation with your family, and you decide that while you're gone, you're going to drop your car off at one of those parking plazas at the airport where they store your car, they keep it safe, it stays in the lot, and then you come get it when you're done, and you pay a nominal fee for them to do that. So you come to me, I own one of those places, and I'm like, good, $100, I'll take care of it for you. Your car is going to be safe when you come back. Just bring your voucher and I'll give you your car back. So you go on your trip, you have a great trip, everything's going well, and you come back and you come to get your car and it's not there. And you're like, Jerry, where is my car? You told me it would be here. The point of me bringing it here was for you to keep it safe for me while I was gone, and it's not here. Where is it? And I tell you, okay, Gabe, you're going to be mad, but I while you were gone, you weren't using the car, so I rented it out on Turo, and I've been making income on your car while you've been on vacation. And you're like two responses. A, you're like, that's brilliant. Why didn't I think of that? I would have just done that myself if I had thought of that idea. And then B, you're kind of mad that I didn't tell you about it, and that I'm also not sharing the profits with you. You're like, that's my car. If we did a 50-50, I wouldn't even be upset. But right now I don't have my car, and you've been making money and I didn't get any of it. Right. And I could have just put it on Turo myself. You start having all these thoughts. Now the plot thickens, it gets worse, because you're like, all right, where is my car? And I'm like, well, right now it's being rented out. When it comes back, I'll give it to you. And I'm like, but Gabe, there's one problem. And you're like, what? And I was like, the guy that rented it, he wrecked it. Your car has been damaged. And you're like, well, do you have insurance? And I tell you, I mean, technically we do. And you're like, what do you mean technically? And I was like, well, we have it, but we haven't been paying the premiums. And so it's not going to cover the car repairs. That's going to have to come out of your insurance, and it'll come out of your deductible will come out. Your premiums are going to go up. You'll be pretty pissed at this point, right?
I'm not liking this story, Jerry.
So this is what happens though in the bank, right? It's funny. We think about it like a car, and people, if this happened, they would be like teeming with anger. But it's the same thing with the bank. You put your money in the bank. They loan it out to other people. They don't really tell you about that. They make all this profit. They don't share it with you. Silicon Valley Bank, like you have a bank run, you come to get your money and it's not there. And then the FDIC insurance isn't even been funded. Like I think about a decade ago, the bankers lobbied with Congress to not have to pay the premiums on that. And so the US Treasury bails out the FDIC because they've only got enough money to cover about 1% of deposits. Which means when that happens, me and you and everyone listening right now pays more in taxes because of that. So the bank takes our money, puts it at risk, loses it, or makes profit on it. Both are bad in my opinion. And then when they lose it, it's coming out of our pocket to pay back our own money through the taxpayer system. So this is what's going on is the bank borrows this money. They're going to loan it out to someone, let's say just on a mortgage. Let's be conservative and let's say that it was a mortgage 2 years ago and they're going to be charging 4%, right? And so their spread is the difference between 4% and 0.40. The bank keeps that difference, right? So this is their spread. And then that spread is their profit, right? There's shareholders that own the bank. Now, the story that doesn't get told is that the banks are the number one owner and purchaser of whole life insurance on the planet.
What?
So they're taking all of this money, Gabe, all the things they're doing, and then when they get the profit, the first place they put it is these life insurance policies.
Amazing. Okay.
So my thing is, okay, if we just change one location, which is we use a whole life insurance policy instead, right? And so when we use the whole life insurance policy instead, here's where it starts to become its own banking system is, I'm still going to deposit money. All the money I would save with banks, all the money I'd save with Wall Street, all the money I'd save with the IRS. And again, guys, words matter. Definitions of words matter. One of the first steps towards building wealth, I'm sure you're going to agree with this, Gabe, is pay yourself first, right? And so when you think about that phrase, pay, like transfer money to yourself, meaning me as the individual first before everyone else, do we really do that? And when I was a financial advisor, I would teach people to pay themselves first, and they would think they were. But if you think about when you put your money with Wall Street, did I really just pay myself first, or did I pay Wall Street first? Right? And when the IRS takes that money out of my paycheck, and I get that refund at the end of the year, some people that's a function of their saving. They would not save money had it not been for the tax refund. But you're not paying yourself first. You're giving Wall Street, you're giving the IRS a 0% loan for a year. When I put my money in a checking account or a savings account, am I really paying myself first, or is the bank being paid first? Because pay myself first would mean that I'm the one that benefits. I'm the one that has control, and it's building wealth for me. And when I put it with Wall Street, I don't benefit. I don't have any benefit today other than the tax deduction. Right? I can get tax deductions for losing money or giving it away also. So we can't really put too much focus on the tax deduction. There's other ways to get that, but I lose control of it till I'm 60, right? And I don't benefit from it. Wall Street and the IRS make more money on that deal than I do. With a bank, they're going to loan it out and make money on it today. That's not my benefit. So to pay myself first, I would have to be putting it somewhere that I own, control, and benefit from. If I don't own, control, and benefit from it, that wasn't paying myself first. So people think they are and they're not. And if we switch this and we say, okay, the location, let's make the location somewhere that you own, control, and benefit from. That's the only change I'm asking you to make in your life right now. Okay. And so we deposit it instead into the whole life insurance contract. So let's just talk about from a depositor standpoint, what's happening, right? So I deposited there. The difference here on my deposit, I'm going to scroll up a little bit, is safety. Just like when I store anything, the expectation is of safety. Our story about putting money in the car storage, it's the expectation of safety that I have my car back. When I store milk in the fridge, it's the expectation of the safety of the milk so that I could use it again. I wouldn't put ice cream in my closet. It doesn't do the job. That's what the freezer's for, right? So storing things in the right place. So when I store as a depositor, like we mentioned, the money's guaranteed against loss. It's guaranteed to grow, right? It's not taxable. So this is a big one. You literally are not going to pay taxes ever again on any dollar that you put into the system. So much so that in the 1980s, Congress established what was called the MEC limit because wealthy individuals were putting all of their money in here and opting out of the tax system. They would just be done. So Congress had to say, hey, you can't do that. We need to put a limitation on it, right? Now that limitation, the insurance companies are in the pockets of Congress, like COVID happened, that final stimmy check we got in December of 2020, in the bill for the COVID stimulus thing, the life insurance companies put in a provision to increase their MEC limits. The MEC limit is the contribution limit. And I'm looking at this, number one, I'm on this. I'm like, that's amazing. Like, of course, because of COVID, we need to be able to put more money in our life insurance. That totally makes sense. But also that's how powerful these companies are. Joe Biden has 6 of these, right? So you want to talk about a security standpoint. These guys, they're a big part of the show, and they have been a long time. They've been around longer than the Federal Reserve was established in 1913. These insurance companies are the 17 and 1800s. right? You can study wealthy family after wealthy family. They use these. So you're not paying taxes. There's no stock market volatility. You're not paying any wealth management fees. The money in your policy is protected from creditors. So, if you have a real estate deal gone bad and you haven't done your asset protection and you get sued, they can't touch your life insurance policy. That one's off limits, right? It's also protected from lawsuits. Okay, so who remembers the O.J. Simpson trials back in the 90s? Right?
Everyone, yeah. If you were alive at that time, that was the biggest thing on TV at the time.
And I was like an infant, and even I know about it. I was born in 1992, so that's like, and even I know about this. So there was two things that happened. There was obviously the criminal suit where they tried to find criminal charges and couldn't. There was a financial one as well where the family went after OJ's assets. They couldn't get his assets because he had it in life insurance.
Interesting.
A lot of people don't know that, right? And then you have total privacy. We live in a day and age where people are all about privacy, and that's the craze behind crypto is privacy. I don't think it actually has the privacy that we think it has, but this one does. It's a unilateral contract between you and the insurance company. You're the only one that's allowed to change it. Loans do not get reported to the IRS. It's a private transaction. It stays between you and the company. You can't say that about a savings account and a checking account. Every transaction you do gets reported when you put money in a bank, right? So these are the benefits on it. So when I'm putting money in here as a depositor, the company that I'm with right now on one of my policies, they're paying me a 3.25% guaranteed interest rate, right? That's more than I'm getting in the bank. Plus I have all these protections. Plus I have a death benefit. Plus I have full allocation of my money. They're not practicing fractional reserve banking on my dollars. They're not allowed to, right? So as a depositor, I make more money. Now, as a banker, I'm able to then borrow against my deposit, right? Now, we can't forget I'm also a shareholder. So this is 3.25, and then I'm also making another maybe 2 to 3% per year in dividends, right? And this is where we said, between the two, at like a net compounding annual growth rate, between the two, we're looking at about 3 to 5%.
That makes sense.
Right?
So you add them, and when you add them, you get somewhere between 3 to 5%.
Yeah, when you add them and then you annualize that over the life of the policy, right? So there are some years where I'm going to full on get 6%. I've got 100 grand and I'm going to get $6,000 in dividends and interest. Right now, that's going to be as the policy capitalizes and builds. In the early years, it might be a bit less than that. And so I want to look at like just on any given year without diving into specifically year 12 of the illustration. Here's what you got. We can get that nitty gritty, but from a concept level, it's easier just to say, hey, from 0 to age 121, it's 3 to 5% on average any given year, right? So I've got this rate happening. Now, as a banker, I can borrow against the deposit. Okay, so when I borrow against the deposit, I have a cost of borrowing, right? Most insurance companies, they're an interest-only loan. It's annual simple interest. The rate is 4 to 6% to borrow, right? Now, there's a couple things that I would point out here. The first one is that one of the benefits of this is you never need to get a credit check because you're an owner in the insurance company. They don't care. They're going to issue loans as long as you have cash value and you ask for a loan, they're going to give you one, no questions asked. They don't want to know what you're going to do with it. They're not going to withhold taxes. They're not going to run your credit. They're not going to tell anybody. Just boom, here's your loan, right? The second thing is that loan never actually needs to be repaid. Now, some people think this is the secret, and it's not. You should always repay your loans, okay? But you don't have to. And that's the difference between this and someone else's bank. I have to repay my loan on someone else's bank. With this one, I could just service the cost of the interest, and when I die, they'll just take my outstanding loans out of my death benefit. And that's that. So they don't ever have the expectation of being repaid. Now, I have to realize I'm wearing different hats. When I'm the depositor, my hat is I'm the depositor. My job is to put money in my account. As the banker, my hat is different. My hat is to always keep the money working by borrowing against the deposit and always earning more than my cost of interest when I make that loan transaction with investing or paying off debt or whatever it might be, right? Now, the other factor on this is you've got to understand the difference between your gross interest rate and your net effective interest rate. Right? My gross interest rate, they're going to charge me 4%. Well, when is that? Well, that 4%, if I borrow 100,000 and never pay it back, I will pay $4,000 per year. But what if I pay it back? right? If I pay it back, I'm reducing my balance every single month. That 4% comes off of a smaller and smaller number. And if I'm really smart, I'm using it for business and investing. I'm going to write my cost of interest off on my taxes too. And so if I take my total dollars spent on interest, including the fact that I paid my loans down every year, including the fact that I took a tax deduction, my net cost of interest is closer to 1 to 3%.
Interesting. Yeah, it's a complete mind shift, right? You have to shift your mindset from thinking like a depositor to like thinking like the bank. Like it's a completely different way to think about how I use money.
Right. And what it does, because you're going to do the same things, right? Like I deposit money in, I'm doing that. My deposits are being borrowed against. That's happening. I'm just the one that's able to borrow against it now. And this is the one that gets me, Gabe. I finally had to just like kind of level with people, because I would constantly get this question: why do I borrow against my own money? Why would I put money in here to borrow against my own money? And we went through like the idea of like the car loan and all of that, and that usually helps. But here's a better question: is when people are like, why would I put money into this and then borrow against money that I already have? And my question is, why is it okay for the bank to do? Why would you deposit money into a checking account to let the bank borrow against your money? And why is it when I tell you that you're the one that can do the borrowing now instead of the bank, you think it's weird? Right? Like we have to respect our own wealth more than we respect the bank's wealth. The exact thing I'm explaining already happens to your money. I'm just saying cut them out of the middle, right? Including the life insurance part. They're already doing this, right? So we borrow, if we do this correctly, our cost of borrowing is 1 to 3% per year, right? Now, when we borrow it, we're loaning it to ourselves. So that's a third hat we're wearing. So we're wearing the hat of a depositor, we're wearing the hat of a banker, and we're wearing the hat of a borrower. When I'm a borrower, what is my number one focus? Make more money than the loan costs and pay
Correct.
that loan back as agreed, right? And so whether I'm paying off consumer debt, whether I'm self-financing a car, whether I am doing a real estate transaction, I'll give you guys an example of one I just did. So I bought a vehicle, right? I deposited the money in my policy first. So I did that first step. And then I borrowed against the depositor. I'm the banker. Then I loaned it to myself to buy a car, right? So now I take this money out, I buy a car with it. So I walk in there, I have my money for the vehicle, boom, cash purchase. Most people, their instinct would be to stop there. I just paid cash for a car. No. That car needs to do two things. It needs to make money, and that loan needs to be repaid. So before I borrowed the car, there was a little step in there where Jerry, you go into the bathroom, you look in the mirror so you can see Jerry the borrower and Jerry the banker. And Jerry the borrower says, hey, I need 40,000 for a car. And Jerry the banker says, great, that's awesome. I'm going to charge you 6% interest, and you need to pay it back in 5 years. Here's your monthly payment. Okay, and we in the mirror do a little handshake, and I say, great, this is my monthly payment. And I put up an auto pay every month. I'm going to pay that policy loan back as agreed, because that's what I would do if it was someone else's bank. Why would it change just because it's my bank? Why would I all of a sudden say I'm not going to pay loans back? It's the equivalent of owning a grocery store and saying, I want to buy apples. And instead of going in and buying apples, I'm going to steal them out of my inventory because I'm the owner and I get free perks. Right? No, that wouldn't make any sense. You would still pay retail price for the apples because that's a business, and the business is not you. You're separate. So you have to separate yourself from the bank. You're not the bank. At some points you are, but when you're borrowing money, you're not. You're a borrower and you need to pay your bank back. Right? Now, here's what I did here is I took the car and I'm leasing it to my corporation. So I'm doing a lease agreement. Yeah, it's super cool, right? I'm leasing it to my corporation. So my S corporation has an actual lease agreement with me on my car, makes a monthly lease payment back to Jerry Fetta every single month. It's tax deductible for my corporation because it's a company vehicle, right? I now have lease income. Guess what makes that payment back to my policy? My lease income, right? Now, in the eyes of the IRS, my corporation is different than me. That's the point of a corporation. My policy is different than me. That's the point of the policy. And I'm the guy that owns the car. Right? I could even put the car in an LLC if I really wanted to get fancy with it. But since I'm just leasing it to my own company, there's not a ton of liability there. It's not like I'm letting strangers drive my vehicle, right? But I have this lease income, and then I have that tax deduction for the company. And now I pay that lease income back to my policy every month, and it pays the loan off early. I build it back up. I'm still doing deposits. So I build it back up even sooner, and then I can pull it out again for the next thing. Right.
Jerry,
So
I think yeah, I mean, I think that's brilliant. I think you're talking about like a next level strategy where you're using infinite banking to acquire a vehicle and then you lease that vehicle back to your company, et cetera. I mean, I think that's like a next level, but bringing it back to this, I think what took me a while to wrap my head around was the idea that, okay, let's say I want to buy a $50,000 car, to use your car example. I take my $50,000, I put it into I deposit it into my infinite banking policy. And then that infinite banking policy has a cash value, let's say of 50,000. I'm keeping it simple. Then I take a loan from my infinite banking policy to pay for the vehicle. Great. If I understand correctly, that 50,000 I put into the infinite banking policy, it remains in the policy and it continues to get interest. When I take the loan out, I don't take my deposit out. I take a loan against my death benefit. Is that true?
Right.
Okay.
Right. The insurance company is loaning you their money instead of you taking out your money.
Right. And I think that's
death benefit.
Yeah, and I think that's the big difference between how I do banking every day with my bank versus how this would work.
Right, right. And the neat thing on this is, at the end of 5 years, if we skip to the good part, I got tax deductions. So there's a return on investment there. My principal, my 50,000, it kept growing like it never left. It earned interest and it earned dividends the entire time I was using it. Right. Plus I've got lease income. I've got passive income off of this asset. Guys, that is risk-free, time-free, worry-free passive income. That lease income will come in from my corporation every single month, right? You can't say that about it. My annual yield on that for what I'm putting in versus what I'm getting, it's about 26%. But if I take the annual car payment and I look at what's that income and I divide that by the amount that I actually put in to buy the car, I'm not going to get a 26% yield on much of anything, right? That's very hard to come by. So, and then at the end of the year, I'm getting dividends every single year. They're paying me a dividend on this system. And so I'm getting money on top of that as well. And now here's the beautiful part. An actual bank doesn't even have it this good, right? The bank gets to be the banker and the shareholder. They're not also the borrower, right? They're not loaning the money to themselves to go make money with it. They're not also the depositor. So even a regular bank only gets to be 2 out of the 4 steps here. You get to be all 4. Right. And I think that gives us the advantage that we need to really build the wealth we want to build in our lives, because otherwise, a percentage of every dollar we put in goes to a bank doesn't benefit us.
The whole thing makes sense. And if I think about it, you mentioned, for example, in the top right corner, you had the 4% to 6% that you just erased. And I think what you mentioned there was at one point a few minutes back is that if you take out a loan, it could be interest only payments, correct?
It could be, yeah.
In other words, if I spend the next, say, 50 years of my life paying only the interest, then that loan gets repaid when I pass away. That gets deducted from the death benefit my family would receive.
Yes.
Got it. Yeah. And I think that's where it's like the light bulbs came on for me and said, okay, yeah, this makes complete sense. This is a completely different way of interacting with money than the way I interact with money at my bank today. Like it's just a completely different vehicle.
Yeah. And I would say, like, even with that, paying the loans back for me is it's the same function as saving, right? Most of us were used to, you make your car payment and it's $700 and that $700 is now gone, right? Or you make your mortgage payment and it's $2,000 and that $2,000 is now gone. You can't go to the bank the next day and say, hey, something came up. Can I have that money back? Right? You can't do that. With this, it's a line of credit. It's a two-way loan, meaning you put the money in, you could pull the money right back out immediately. So in that scenario, if I'm going to put money somewhere, I always want to put it as either 1, a deposit, or 2, as a loan repayment. And all of it goes to the same place. All of it goes back to my warehouse of wealth, and it's going to stack up and build up and be stored there till I'm ready to use it again. At no point would I say, hey, I bought the car, I only have to pay the interest, and meanwhile, I'm going to save all my money with Wells Fargo, right? Like if that's the mindset, we're still missing the point on this. I want to say, okay, good, I'm depositing, and then I made the car purchase, and I don't have a payment, but I've got extra cash flow, and I should be paying myself first. And so I'm either going to keep making more deposits with my free cash, or I'm going to put that as loan repayments, because ultimately it goes back to the bank of Jerry.
And is it true that really you can never take out more money than what you put in, right? Like what you put in, there's a certain cash value in the policy, and you can only withdraw money up to the cash value?
Yes, but let me show you my illustration now. This is pretty cool. I'm going to show you mine, and then I want to show you guys also one, because this is something that, you can do for your kids. So one of my executives just had a 6 months old, and his name's Dante. Dante already has his own banking system. He doesn't really understand it yet because he's 6 months old, right? But Dante is already building wealth with this. And so I want to show you both of those, because the numbers really are cool to look at, right? So this is an actual illustration. This is one of mine. I just opened this. So here's how my life works. I have several policies. I have something that I use called a segregated account. Every month I take 40% of my income, I stick it in that account. Right now, my active income tends to grow because I do business and investing. So it's 40% of a larger and larger number over time. So what happens is from month to month, I'll start seeing, after I did all my deposits, I did all my investments, there's typically a consistent amount of money left over in that segregated account. And when it's enough, I'm like, well, shoot, I'm going to go open another policy. I don't want, if I'm seeing there's constantly, $500 or $1,000 or $2,000 that's being left over, it's like, good. I don't want to leave this in my bank. I don't want to leave this in my segregated account. Let me go put this in my sacred account with my life insurance policy instead. Right. So I recently did that. I was, doing my normal financial accounting of making my transfers and loan repayments, and those are all automated. But I noticed there's $1,000 a month that's always left over. Like the last couple of months it's there because it's growing, right? My income grows. So I'm going to go open another policy. So this one is just a little guy. This is $1,000 a month policy. And so you can see the premium is about $12,000 per year. And I'm just going to highlight and notate the important parts on this. And this is great because I think the number one problem with people is they never see the illustration. Like you said, Gabe, we just hear the concepts and we're like, that's a scam. Like I like just this story of like, you could put money in and it grows, and you borrow against it and it still grows, and you own the company and it's infinite bank. You're like, this sounds like, some Nigerian prince, and I might lose my kidneys at the end of the story. Right. So here's an actual illustration. Here's actual math. This is what did it for me, guys. I was a Dave Ramsey endorsed local provider in 8 states. I thought whole life insurance was the second cousin of the devil, right? So there was no way in heaven and earth, like I'm going to put money into this, because I was like, you just never put money in whole life insurance. Till I saw a properly designed illustration, and it flew in the teeth of everything I was ever taught, right? So before I dive into this, I want to give you guys a couple of different concepts. There's different ways you can design these. The biggest change is going to be how much money do I want to allocate towards my cash value versus how much money do I want to allocate towards my death benefits, right? So traditionally, Nelson Nash is kind of the one that made this concept popular and mainstream. His policies, he would typically design when he puts money in, about 60% of this goes into cash value, and about 40% of your deposit goes towards your death benefit, right? Now, the death benefit is a share of ownership in the insurance company, right? So $1,000 of coverage is 1 unit of death benefit. The more thousands of coverage I have, the more units I get, therefore, the more dividends I have, right? My cash value earns guaranteed interest, and the dividends get credited to it. My death benefits produce the dividends. Therefore, if I own no death benefits, I will get no dividends. Right. So Nelson Nash would do 60-40. If I put in, $100,000 a year, year one will have 60,000 available, 40,000 of it bought death benefit, the dividends then pay into the cash value. And that's kind of like the old faithful concept, right? And that's in the later years, it really takes off because you invested in so much of this dividend producing asset that it snowballs and compounds, right? Now, the other one you can do is you can do like a 70-30 split. Right, 70-30. Right, on a 70-30 split, you've got a little bit less death benefit. You're getting a little bit more in cash value. And so it's kind of, you don't have quite as aggressive as you would see in the later years, but you've got a little bit more money up front. Okay, now the final one is called a 90-10 split. Right, 90-10, and I have a 90-10 policy. Short term, I have more money available than all my other ones. Long term, the performance sucks compared to my other ones, right? And so this is up to you when you're designing it. This is part of what we help with. We consult with you on, okay, what are we using this for? And let's design it properly. The poverty mindset in all of us is going to gravitate towards, 90-10. I want 90% of my money available. For me, the one I'm about to show you, I think is a 60-40, right? We'll do the math on it in a second, but I'm pretty sure it's a 60-40 or a 70-30. And the reason being is when you understand the concept and you see what I'm about to show you, you're like, okay, this is a long game. Wealth is a long game, and I want the long-term result of this. And I don't want to sacrifice it because 90-10 is better for like 2 years. You get a little bit extra money for maybe the first year or two. And after that, it pretty much catches up. All the other ones will catch up around year 3, 4, and 5. Then they're all about the same. And then after that, the longer term focus of buying more of this, Nelson Nash calls it capitalizing your policy. It takes off and it then far surpasses anything else out there, right? So this one I believe is a 60-40. So here's my annual premium. Here's my deposit. Here's my net cash value in the first year. And so if we just do the math on this really quick, I put in a little under 12,000, right? So I've got 85.68 available in cash value the first year. I put in 11,869 and 61 cents. So mine, this is about a 70-30. I call this my liquidity. I put in year one, I put in X amount. Here's what I can borrow. It's about 72%. Right? Now, it's important to understand where that other 28% went. It purchased the death benefit. So I've got net death benefit here of 331,000. Okay. So I have to be okay with the idea that the trade-off here is I'm not going to have access in the first couple of years to all of the money. Okay. So this is not my payday lender. This is not something that I'm going to pull it out next week to buy groceries. This is a strategy, and you've got to work the strategy. You're capitalizing a bank. If you wanted to start a bank, typically it's a $25 million startup process, and it's years worth of getting your approvals and sponsorships and compliance. We're telling, and it's not going to break even right away. Like with any business, the first 5 years you might fail. So I'm telling you, have the same approach to this as if you were starting a business. This is not just a savings account. This is a banking system. So you want to think with, I want to be around in 5 years. I want a consistent, workable process. And then after that's done, boom, I'm going to make more money than I ever thought I could put into it.
And Jerry, what is the difference between those two columns? I see a column called cash value and another column called PUA cash value.
So PUA cash value, that's a great question. So PUA cash value, and you'll see it over here as well. This is the guaranteed column. This is the non-guaranteed column. The guaranteed column says, all right, if we never earn dividends, because dividends are not guaranteed. If we never earn dividends, what would we make, right? And so they're saying, well, you'd put in this and you'd have this available, right? Now, if we look at the last 200 years, we can't guarantee dividends, but they've never not paid them. So that's the non-guaranteed column. And so here they're showing, okay, well, in the first year, you'll make a little bit of dividends and interest. And so here's the total if you account for the fact of dividends and interest happening. Right. And you'll start to see a pretty significant difference. They've got them side by side here. Right. And looking at when I earn dividends and interest versus when I only earn interest, this is just that 3.25% guaranteed rate. This is both, right? Both the dividends and the interest. Later years in the policy, we look at year 15, for example, that's a $40,000 difference per year in dividends and interest versus no dividends. Right. So they show both of them just because technically you can't say a dividend is guaranteed, but also the sun coming up isn't, but it has happened for a while and I would expect it to tomorrow.
and Jerry, I see that in year 11, the premium drops to only 2,967. Why does the premium drop there?
Yes. So basically, what you'll see on these is you can design them for your own, like how long you want to put money into them, right? So on this one, I have it set up where this is year 10. After year 10, my premium drops down a bit. By doing that, you can create more liquidity up front sometimes, right? And so, if you have like a shorter pay period, now I could have designed this where it's the same all the way through. For the rest of my life, I'll pay in $12,000 per year. With this one, it's more, a higher early model where I said, okay, I want to do a shorter contribution period. I'm not really putting any lump sums into this, and I have 4, 5, 6 of them, and I'll continually open more. So you could say, I want to do a 10-year contribution. I want to do a 20. I want to do for the rest of my life. I want to just do for 5 years. That's up to the individual. And again, we kind of design and consult with you on like, how long do you want to contribute for, right? I have some where I'm going to contribute the same thing for the rest of my life, right? It just kind of depends on what you're using it for. Since this one is more cash flow based, it's $1,000 a month going in, and so I'm looking at this for me personally, and I'm like, okay, that's $1,000 a month going in. Probably that number is going to increase over time, and I'm going to open another policy anyways, and I want to continually open more of them. So I'm gonna early fund it. I'm going to push a lot of money in up front, and then it'll drop down just to maintenance. And if I have more free cash flow at that point, I can just open more policies up, right? So that's kind of my line of thought with it. Now, what we look at on this is we've got 72% liquidity in the first year, right? Now, if I go down to, let's say, year 10, for example, which would be a good point of this. Let's say I'm in year 10. I've got $122,000 available, right? Now, I'm going to do some math with you guys. And when I first ever did this math, it blew my mind, right? So I'm going to pull my calculator up. All right, so I've got $122,831 available. Now, let's say in year 10, Gabe, I borrow my entire cash value out, 100% of it, right? And I'm going to go do real estate with it. Mm-hmm. And so I'm like, great, I'm going to borrow $122,831 out, and I'm going to invest that in a real estate deal like seller finance, and it's going to pay me 12% interest a year, right? Mm-hmm. So that means that I'm going to be making on my real estate investing $14,000. We'll just call that 740. We'll round up $14,740, right? That's going to be my income there. Now, traditionally in a bank, when you're using someone else's bank, that is, if you pull $122,000 out, they're not going to keep paying you interest. You're done, right? Your money's not going to keep growing. Okay. Now, what happens is we look at the next year. We have an increase on my cash value. My cash value, even though I pulled all of my money out, my cash value still goes up to $129,921, right? So if we look at the difference, it's amazing, isn't it? We look at the difference on this. That is an increase year over year of $7,090, right?
That's incredible. Now, and sorry to interrupt. I mean, when you say you pull the money out, are you actually taking it out of the policy, or are you just borrowing against the death benefit?
Borrowing against it. So I'm taking a loan against it.
Got it. Okay.
Yeah. And so by taking that loan, I have, the cash still there growing, but it feels like I did a withdrawal. I took 122,000 out. That's what I had in my cash value. If I did that anywhere else, there's no way in hell that I have 129 grand in my account next year. It just doesn't work. Right. So with this system, it does. And one of the reasons it does is because the loan feature, we've got the interest and the dividends happening, and we've got that happening whether I borrow the money or whether I don't borrow the money. So in this case, I did borrow the money, and I used that money to make almost 15 grand, right? Now my cash value went up by $7,000. Okay. Here is the math that when I saw this, because so far everyone's tracking with anything, I'm about to pull a wild card out of my pocket that none of you expected. That when I saw this, I was like, okay, I want to put every dollar I ever earn into this. So my cash value increased by $7,090. In year 11, I only put in a contribution of $2,967. So what that means is, if I take my contribution here and my growth, I had $7,090 increase. If I divide that by my contribution of $29.67.41, it means that I put in $1 and 2.38 new ones showed up.
That's right. So in theory, your contract premium could go to zero, right? Like you could just take that money out to fund in year 11 or year 12, and it would still keep going in theory.
In theory, yeah. And you could see that with, I'm working with a family now. They're pretty close to retirement. So they're like, hey, we love the concept. in reality, we don't think we're going to save for the next 20 years. We're going to start, withdrawing and living off income. So I'm like, great, let's do like a 10 pay or a 5 pay where you pay in for 5 or 10 years and you pay nothing after that. And it's still going to keep growing and it's still going to pay dividends. Will that be as aggressive on performance? No, because we're not fun. Just like a business, if you quit putting money into a business, it's not going to grow as much as a business that you're constantly investing in. Will it still grow? If it's a good one, yes, right? And you'll be able to maintain that.
Amazing. Got it.
So for me, I look at this as my magic ATM machine, where in year 11, I put in $1 and my dollar turns into 2.38 new ones, right? And that's that increase, increase in cash value of 7,000 and I only put in 2,900. So, if you could start a business where, the first, 2, 3, 4, 5 years, yes, you do need to capitalize it, but you still are borrowing against, we look at the first couple of years here, you put in 11,869 and 61 cents times, let's say 3 years, you've put in 35,608 at year 3, and you've got 27,951. So even with that slight loss in liquidity, that's the investment, that's the trade-off. But tell me another business where you put in 35,608 and you've got the majority of that available for you to use right away, right? It just doesn't happen. And then you look at the point of time where, you're putting in, 2,900 and you're pulling out 7,000 in the same year, right? I can't even do that in real estate, right? But if we just look at the returns on this, on the real estate transaction, I did 14,000, right? And then I had cash value growth of, I think it was 7,090. So then we add in the 14,740, right? My gross income on that between loan interest, real estate, everything was 21,830. Now we might look at that. We can just total this up really quick. So we make the numbers nice and clean. This is 21,830, right? Now we also then have to look at, okay, well, we did take a loan, right? 122,831. If we did what I'm saying, and we're paying that loan back every month, the income that I'm getting from that real estate, I'm paying back to my cash value every month. It's going to go somewhere. So it better not go in Bank of America, right? It's either going to go back into my deposit or I'm just going to repay my loan. Either way, it goes to the same location. Either way, I can pull it back out again tomorrow. Either way, it grows. So the loan interest on this, if I'm repaying my loan every month and I'm taking my tax deduction, my actual interest rate should be maybe like 2.5%, 3%, but let's call it 2.5%.
Right.
So my loan interest for the year was 3,000, right? So I take the 3,000 out of this, I still made 18 grand net off of 122,000.
That's amazing. That's absolutely incredible. And Jerry, a couple of quick questions for you. You mentioned, for example, that President Biden has numerous policies. You mentioned yourself, you're always opening new policies. Why open more than one policy rather than just modifying one to suit your needs?
Very good question. So each policy you open, it's going to have a contribution limit. That's called your MEC limit. So that MEC limit is going to be based on your death benefit, right? And so when I open a first policy, I'll be able to put in X amount of income. And so if you're maxing that first one out and you've still got money you're saving, you've still got excess cash flow, then you've got your first bank going. Just like any good bank, they've got a bank on every corner. So it's about opening that next location. So I'd open the next one and then I would put my excess cash flow there. And that way I'm constantly, putting money in and opening policies. It's easier to do that because when you modify an existing policy, the process is actually longer and more time consuming. And there's more constraint around it because you're taking something that's already existing, just like a business, right? If you take an existing business and you said, okay, good, I want to increase the revenue. If it's a really tight-knit business and it's running and functioning and your staff are all trained and your systems are in, you don't want to go in and unmock that. You don't want to go in and say, good guys, let's change everything and try and, make changes and put more of this or more of that. You want to then just scale another location, right? Just like, a bank or a franchise would, is they take an existing successful concept and then boom, they put it into another one. Or a rental property. Instead of, trying to renovate and add another unit, it's easier to just go buy another unit, just have another door somewhere.
So it's actually, there's no limit on how many you can open, and it's easier to open a new one than to modify an existing one. So why not just keep opening them?
Precisely. Yep. And to give you an example, so Nelson Nash, he's kind of, again, the one that really founded and made popular this concept mainstream, because you have to realize before Nelson got this out there, this was only banks and wealthy people. The average individual would never have known that they could do this, and nobody wants them to. Like, if you think about when you put money in this game, the IRS, like if every US citizen had money in their sacred account, the IRS would fail because no one would pay income tax ever again. The banking system would fail because we wouldn't be borrowing against other people's banks. We'd be using our own, and Wall Street wouldn't be around because we wouldn't be putting money in risky deals. We'd be focusing on deals that pay our policy loans back, right? So it automatically gets rid of what I consider the big three bad guys in the story. The banks are the number one owner and user of this. And almost every bank has a life insurance license, which means they could sell this to people, and they don't. Instead, they would rather sell you hospital indemnity insurance and accidental death policies and things where they make a bunch of money, right? So Nelson Nash, before he passed away, last I heard, he had over 50 policies. One of my partners, his name is Brent. Brent has, I think, 20 something policies. In scheduled premium contributions, he's putting in about $700,000 per year, and he has self-financed the private jet with his policies. So, I mean, really, like the name of the game is just like with real estate expansion or a business, more locations, right? I want to go wide and have as many locations as I can. By the end of this year, I should have my 7th or 8th one open. And I just continue because it only takes about a month to open them, right? And if you're really growing your income and you're constantly investing and doing the things that we talk about, you should always have money that you're wanting to put somewhere.
And at the heart of it, it is still a life insurance policy. So when you open one up, I imagine, like, do you have to go to the doctor? Do you have to get like a medical exam, et cetera?
Sometimes on your first one, often yes. Right. So, and they're getting better at that. There's certain companies where I hate needles. Like, that's for me the part that I've never liked. I'm the guy that I almost pass out every time, and I can't look at it while it's in my arm. And I'm like, oh God. The peeing in the cup part, I don't mind. When they do your urine analysis, I'm like, I'm good with that. That part's kind of fun, but it's the needle in my arm. So there are certain companies where they've switched to a spit swab. So you swab the inside of your mouth, you send that in the mail, and they can get everything they need with just that. Some of them will reuse medical exams. So if you've recently done a medical exam, for example, I haven't done a medical exam. When was my last one? Maybe 2 years ago. Yeah, maybe 2 years ago, I did an actual medical exam. Oh, no, I didn't. I did one like 5 years ago. So somehow they know I'm healthy, right? So they're using medical records. This policy I just opened, they did not do a medical. They just did an interview, and that was it. There was no blood and urine. There was none of that. So it's varying per company and also per the person. If you're a really healthy person and that's apparent, they're not going to want to collect a bunch of data. The more stuff you've got with like health and family predispositions, that's where they might be like, hey, we want to, do a little bit more on the medical and do the blood and urine and stuff.
And if you don't mind, could you bring up that one table again that you had where the 4,000, because I got a couple of questions. So obviously, I believe it was age 35 when this policy got started. Yeah, age 31, right? So in this policy, the person who took it out is age 31. How would the numbers change if somebody, say, is age 45 when they start?
Good question. So this was one that even myself, because I grew up in selling term insurance, right? So when you're doing term life insurance, you're used to the older you are and the less healthy you are, the less death benefit you get, right? Because it costs more to buy a death benefit. So this is true, but you have to keep in mind the purpose of this. The purpose of this is not death benefit. We actually want the least amount of death benefit possible and the most amount of growth in cash value. So for me and you, let's say I was 50 and you're 31. And we both get $300 and we go down to the grocery store, no difference in our spending power, right? We can get the same amount of vegetables, milk, eggs, bread, etc. Now, if we both took our $300 and we headed down to State Farm to buy death benefits, you would be able to buy more, right? Because you're younger, you're healthier, etc. Okay. So that's if you're trying to buy death benefit. We're not trying to buy death benefit. We're trying to achieve a certain allocation of cash value and dividends. And the death benefit, it is whatever it happens to be. So if I'm 31 versus 45, I still could do a 70-30 split and see about the same growth. The difference being the 45-year-old is just going to have less death benefit, right? But the cash value is still the same proportionate ratios. The dividends are still the same. The growth is still the same. The only difference is the older person, they bought less death benefit, which again, we're not really focused on that part. It is nice. It is there. It is life insurance, but we're not leading with it the way that you would be with term insurance.
Got it. Okay. That kind of makes sense. And when you mentioned that one client of yours who opened up one of these for their 6-month-old child, right? How would, I guess I'm trying to understand, like, what would that child use it for? Like, would this child be able to use that, the cash value for things like tuition when they go to college or buying their first home, or what would be a typical use case?
Yeah. So actually, let me pull that one up and actually show you guys the illustration. So this is Dante. So Dante, we call these mini moguls, right? These are people that the parents, they care enough about their kids that they're teaching them this stuff, right? So Dante is a mini mogul. Dante is 6 months old. He's in Canada. So recently this year, we've been able to expand into Canada. So this is a Canadian policy. For all you guys in Canada, you can set these up. Let me share the illustration here. All right, so Dante, 6 months old, right? And so with a 6-month-old, they're typically able to have the death benefit. It's based on what their parents have. They can typically have up to half of what their parents have in death benefit, right? So in Dante's policy, what they did is they started with an initial lump sum of $2,500. So they put in a lump sum of $2,500. And that's on a different page, but I'll go ahead and just write this up here in the top corner. But that was our lump sum dump in. His year one cash value is $1,945, right? So, and then they're following it up with an annual contribution of a little over $1,000 a year, right? So we can see that they're putting about $1,000 a year. Now his is one where they didn't change it. They're just like, we're not going to drop it down at year 10. Dante's 6 months old. Let's just always and forever put $1,000 per year into this, right? So first of all, Dante is super cute. So whenever I talk with Sam and we talk about Dante's policy, he's a super cute little guy. And so she's putting this policy together. Her and her husband are for him. He doesn't know about this yet, but right now, for example, we put in $2,500. And so on $2,500, their first year liquidity, they've got $1,945 available, off of a $2,500 contribution. And so Dante has about 77% liquidity, 78% liquidity in his first year, right? Now, as far as use cases, let's say, an easy example, let's say he's 5 years old. Mom and dad have their own policies. They're doing a real estate deal. And the real estate deal is a minimum of $150,000. Dante obviously doesn't have enough for that yet, right? But let's say that they do, and they're like, good, let's take a policy loan against Dante's policy and let's piggyback that into our deal. And that way Dante on our deal can start earning some passive income every month and paying his policy loans back and building this thing even more, right? So they take an $11,851 loan. They put that into a real estate deal. That's paying 12%. So it's paying them $118.51 a month. They're servicing Dante's policy loan with it. And they're just kind of getting him in the game, right? And at 5 years old, like, he's starting to be old enough to have that conversation of like, hey, look at this thing we did. This is yours. We put this together for you. This is the money that comes in every month. And they could hand him that. And that way he can see it and hold it and understand this gets paid back to my life insurance policy. Like, more with kids, more gets caught than taught. So if you can actually involve them in these things, even if they don't get all of it, they're going to pick up little pieces, right? So that's going to be the first thing. Now, the second thing is, let's say that he's down here, 18 years old, and he's ready to start his life, right? So on $1,000 a year, like this, if they opened up no more policies. If they're smart, when he's of age, they're going to hire him in their business and pay him wages and get tax deductions. And he's going to be doing more policies, right? But let's say they did no more policies. They're putting $1,000 a year into it. At age 18, he's got $52,000. Whatever Dante decides to do, he can use this for. So if he wants to go to college, that's part of his tuition being covered through his policy loan. If he wants to start a business, there's his startup costs. If he wants to be an investor, there's the down payment on his first property. right? The beautiful thing of this is it's not limited. A lot of people with good intentions, they will go start up a 529 plan or a Coverdell ESA, and they don't realize they just put their child's future in handcuffs. You now have to go to college. You have to use it for this. You cannot use it for other things. And if you do, there's penalties. With this, they're saying, Dante, whatever you want to do, we're supportive of, and you get to be your own banker, right? So he's got this going for him here now too. Now, the other one is, if we scroll down a bit, is let's say he gets now into the point where maybe he has kids, right? His cash value kept growing this whole time. He's still only putting $1,000 a year into it. When he's age 50, Dante will have $421,000 there. So he can be helping out with his kids. Obviously, they will probably have their own policies, but if he wants to help with their college tuition or invest in their businesses or whatever it is that they're doing, he's got the money to do that, right? Now, what really gets fun on this is when you get down to like retirement age, and Dante's probably not going to learn to retire, right? He's probably going to learn to be financially independent. But let's say we get down to retirement age, he's down here at age 65. Dante has almost $1 million in cash value, still off of just $1,000 a year. We get down to the point where Dante actually might pass away, right? He's an older person, 95 years old. Dante has in death benefit, $3.3 million that will go to someone.
That's incredible. All from just $1,000 a year.
Yeah. And back to my,
wild. That's
I'll
wild.
show you. Yeah, I'll show you, Gabe, the ATM concept on this one again. So let's say kind of similar the game we did on mine. So 95 years old. Let's say Dante at 95, he wants to take a loan against the 3 million. So he's like, I'm going to take a loan against 3 million and I want to invest it, or I want to donate it. I want to do whatever I want to do with it because I can, right? So he pulls the 3 million out. He does a loan, right? Now his cash value will still increase to 3,223,000, right? So he has 3,223, and this is off of $1,000 a year, guys. This is insane.
This is insane. Wow.
3,223,708 minus the prior year of 3,112,555. Oops, I missed the number. 112,555. So that's a year over year increase of 111,153. Right? And that's if the cash value got completely borrowed against. Dante put $1,000 in. So back to our magic ATM machine, Dante puts in $1,015.28. And for every one new dollar he puts in, 109 new ones show up. Like, you show me another system where you put in $1 and 100 new ones appear out of nowhere, right? That's the beauty of the system. So that's Dante's. And guys, like where I came from, I lived in Alaska. So in Alaska, they lease the land out to the oil companies and they pay a dividend to the citizens. Every single family there gets $1,000 or $2,000 per year, per child, per mom, per dad. Everyone should be doing this. Do this for your kids.
Yeah, it's amazing if you think about it. $1,000 a year can completely change someone's life. It takes 60, 70, 80 years for this policy to work the magic with compounding interest, but like $1,000 a year can completely change the financial health of a person or a family. I mean, these numbers are insane.
Yeah, and this is generational at this point. 95 years old. This means Dante's kids and grandkids are going to start off where he finished, right? And if you finished well, they're going to start well, right? And this is like generational wealth. This is legacy. And that's what I talked about at the very beginning, is securing the odds, securing the win at the end of the game, cheat, use the death benefit. So if I don't get there, it's going to happen anyways. And then you might as well get there between now and then.
Yeah, this is mind-blowing. Yeah, I know that. Thanks very much. I really appreciate you walking me through the numbers because I kept hearing about infinite banking like as a concept, but this is the first time that I'm actually seeing the numbers like this, and it's super helpful, and I really appreciate it. One last question is for anyone that still thinks this is like too good to be true, how does the insurance company make money, right? Because if somebody says, okay, car insurance, it's like, yeah, well, a car insurance company can make money, because people don't get in accidents, or they encourage people who get in accidents not to make a claim, Or if they lose money, they just raise their rates the next year, right? Similar with home. How does this, because it seems like everyone dies at some point, so they all have to pay out. How does the insurance company make money?
Yeah, great question. So a couple of things. The first one is I would say you need to keep in mind you own the insurance company. You want them making money. That's your company. You're an equity partner, right? And so when they make money, it also means you made money. Now, how do they go about that, right? So they're at the point where if you look at the balance sheet of an insurance company, they are operating as a conglomerate at this point. They're buying massive, investment portfolios and real estate. And so they're making most of their money by investing, right? If you look at, New York Life Insurance, for example, they're one of the top, in size at least. The last time I checked, their net book value, which is the net worth of a company, was larger than the country of Kuwait. Meaning if they wanted to go buy Kuwait, they could. Like their CEO could wake up tomorrow and be like, I want to buy Kuwait this week. Let's see how much they're going for. And he could do that transaction. They have enough money to do that, right? When they talk about cash reserves, they've got, 20, $30 billion in cash reserves. That's not even reserves for policyholders. The reserves for policyholders are counted as a liability. Mm-hmm. So that's not like when they say cash reserves, they're not saying this is how much we have set aside for policyholders. That's a different number. That's actually a liability on their balance sheet, the policy reserves. That's just the money that they have for their emergency fund is $20, $30 billion, right? So they're doing a lot of investing. And so that's the majority of what they're going to make their money on is investing and growing the company and growing the business. And because it's a partnership, it's very different. We're used to hearing investing and thinking, I make this and then Wall Street takes their fees. They're saying we're investing and making profit and sharing it with you. Mm-hmm. And that's the partnership aspect of it.
And that makes sense, right? If I put money in and that money is earning, like you said, between 3 and 5%, then the insurance company goes out there, takes that money and invests it, and they get, like I said, 10 to 15%, let's say, on their investments. Then that difference helps fund all these policies and payouts, et cetera. And that's how the company keeps growing, which makes sense.
Exactly. Yeah. And the fact that it's mutual, because we're used to they go out and invest it and that's their cut. They're owned by their policyholders. So that's our cut, right? Like that's the paradigm shift. When it's a mutual company, everything they do is for me and for you and for the policyholders.
And one final question. How much does it cost to set this up? Like I imagine, that there's all kinds of fees and stuff involved. How much does it take and how long does it take to set these up?
Yeah, so the setup actually is not that bad, right? So first is a contribution standpoint. The contribution is going to typically be, if you're under age 60, it's 10 times your age per month. So if you're 45 years old, you need to be contributing at least $450 a month into your policy, right? You can also do lump sum. So if you're doing a lump sum, it's going to be, the lump sum going in, and then you'll have your annual contribution. That one's either going to be 10% of your lump sum or 10 times your age per month, whichever is greater. If you're over age 60, then it goes up a bit. It's 15 times your age per month, right? So you'll have more money going in. But again, if you're starting later, you kind of do want to have more money going in to play catch up, right? So the design of the policy, the underwriting, all of that's free. My company, we have what's called an education and servicing fee. So we charge an education service fee of $500. For that, we do one-on-one consultations. We actually build a custom financial blueprint for you. You get access to our online university, on-demand attention from my staff on anything you need. It's the difference between buying a Lamborghini and just saying I have a Lambo versus buying a Lamborghini and having someone teach you how to drive the thing.
And I'm glad you used the example of Lambo because, Lambos are notoriously not the best handling cars. So people tend to crash them up. So
yeah,
good analogy.
Even a BMW, when I grew up poor, right? So I was used to driving hoopties and I got my first BMW and I got in the thing and I was like, I don't know what to do. Like there's all these knobs and buttons. I'm used to cranking the door to roll the window down. Like there's a button instead of a key. So they did this teaching me how to drive my BMW course. And I was like, this was phenomenal because I would never be able to tap into the potential of the car otherwise.
Right on. Well, I really appreciate taking the time with us. I know this was a long recording, but I really appreciate taking the time out of your weekend, Jerry. And this was super helpful, super insightful. Where can people reach you if they need to learn more or if they want to contact you personally?
Yeah. So if you want to contact me personally, reach out to me on Instagram, Jerry Fetta, right? Just my first and last name. That's 2 R's and 2 T's. And then if you're watching and you want to learn more about this, I want to give you a free masterclass that will give you a full deep dive on this. So if you go to sacredaccount.com, that's the word sacred and the word account, not secret account, sacred account. Not scared account either. Sometimes people will typo and mix the C and the A. It's sacredaccounts.com. You can take a free 90-minute masterclass there and get the full education and also a free consultation with my team if you want to learn more about it.
Fantastic. I really appreciate your time today. And yeah, man, this was super insightful. I'm really glad that we're able to get into the nuts and bolts of it, to see the details and see how this works. I agree with you. This is quite revolutionary. It's something that blew my mind when I first heard about it. And it is something I think everyone should know about because it is extremely powerful. And yeah, thanks very much again for your time and have a wonderful weekend.
Thanks, Gabe. You too.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors and it helps attract new viewers to the show. We appreciate your support. Thanks very much.